This episode of the e-commerce playbook is brought to you by TaxCloud. Sales tax is overwhelming. Never mind the stress that comes with a provider that's overpriced, unreliable, or leaves you waiting days to get a reply. TaxCloud is here to tell you that there's a better way. They're not just a tool, they're a trusted filing partner for growing Shopify brands. They'll work directly with the states on your behalf to handle registrations, filings, and ongoing compliance so you can stay focused on growing your business. Go ahead and check them out at taxcloud.com/thread. Listeners get free migration onboarding services when you decide to make the switch. That's taxcloud.com/thread.
Welcome back to another episode of the e-commerce playbook podcast. I've got the D2C Index crew with me and a special guest. We're playing a game of Defend That Tweet, and this time I didn't start the controversy. So that is good news for me. I'm excited for this conversation today, though, to get a little view into the state of the index, our state of the industry here with this crew. I'm going to let them all introduce themselves. Jeremiah, you go first. Who are you? And what are you bringing with you today to contribute to this conversation?
I'm Jeremiah Prummer, founder of Ecommerce, CEO now of Ecommerce and Stamped and Repeat, lots of stuff. But the key thing that we've been looking at for years now, plural, is consumer sentiment and consumer confidence for online shoppers. And that's really kind of the lens that we're bringing to the table here.
Great. Rishabh, you want to go next? Your special guest?
Sure. Yeah. I guess I'm bringing the controversy. And by day, I am the founder and CEO of a company called Firmat.
Awesome. Yarden, straight back from the wedding. I think he's still recovering, freshly married, newly married man, Yarden.
What's up, everyone? So I'm a co-founder CEO of Veros. We are a data co-op that brings benchmarks and insights on D2C marketing and revenue data. So it's all first party data that brands are contributing, and then we give an aggregate view on that.
And fresh off of his appearance on the Marketing Operators, the internet has now discovered that he is related to Dave. But Steve, who are you and what are you bringing to us today?
Thanks, Taylor. I'm Steve Recook, Director of Data at Common Thread Collective, and I'm bringing some of those survey results aggregated as well as some of our data from CTC to see how well that survey data matched up against what we saw in terms of performance.
Awesome. Okay, so last week, and I was giving Jeremiah a little bit of a grief for this because it was late Sunday night that you guys really started all of this problem for me as I'm trying to go to bed, just giving it one last scroll to make sure everything's okay. And all of a sudden, I see you all just provoking everyone around this question of what is happening in the industry. And Rishabh, you really kicked it off with some data that you pulled from BuiltWith. So why don't you set up a little bit of what you found, why you were looking for it, and how you interpret the information, and then we'll sort of give everybody's perspective on what we've been seeing as well.
Yeah. So I have not shared this publicly yet. So this is going to be the first time that I'll share the following publicly. So
that's good podcasting right there, folks, by the way. That hook, that's good podcasting right there.
We at Firmat have been observing that in our customer base, there is a tale of two cities. So 48% of our customers have seen revenue decline from January to now, and 52% have seen revenue increase. Of the 48% that have seen revenue decline, roughly half of that, so 25, have seen revenue decline greater than 20%. Of the people who are growing, 60% have seen revenue growth of greater than 20%. So there's roughly 30% that have grown very fast. And so what I was trying to answer is like, is this sort of like tale of two cities barbell thing something that other people are seeing? And so actually the first thing I did was call like 15 other SaaS CEOs. So I published the BuiltWith data because it is public data, not because it is the only data that I had, right? So I called like a very large number of other people who I will not name because they can choose whether or not they want to share their data. And I just asked them like a bunch of questions about what they were seeing. Like, what are you seeing in different cohorts? Are you seeing this barbell? Things like that. And the rough answer from people was that they are seeing it. And I'm curious what other people here would say, but that was the rough answer. And that's why I went to the BuiltWith data set, which it says something very specific, which is why people were like all up in arms and were telling me like, I don't know how to read data, but it's like of the X top websites, how many use Shopify, which tells you a specific thing. It tells you like how many websites belong in that category of top X websites that are actually using Shopify, and will help give an indication of how many brands are doing well, not whether or not total e-com is up or down. And so that was like the thing that I was trying to understand as I think about like, how should I plan for Fermat's continued growth? Like, what are the strategies that I should deploy, and what is the market telling me? So anyway, that's what actually led to the tweet. And then, there was all sorts of kerfuffle.
Yeah, nothing seems to just instigate people like this topic, which is I find kind of interesting. But Yarden, I always appreciate when you weigh in, because I think that you have such an underappreciated breadth of view into this data in a way that I think people just, for whatever reason, have not come to realize just how broad your perspective is here and how much you can add to the conversation. But you jumped in at 4:52 a.m., I think was the time that you posted this for me. So I had to wake up to this again. This is all happening while I'm sleeping. Super helpful, guys. But tell us what you saw and what you added in on top of this BuiltWith data.
Yeah. So, it very much mirrors in a way what proves out, I guess, what Rashad was saying, which is there's an overall, let's like, if you just take an aggregate number, overall, if you look at all stores, revenue year over year is down in the past, especially in, mainly in June, but also in the past few months. And when you split that out and you start cutting into the data, big companies are actually struggling much less, and opposite, they're actually growing and they're doing quite well. And small companies, for the most part, are declining in ways that we haven't seen before. And just to highlight Rishad's his findings and our findings, and the meaning of it is, in this industry, decline it's not like half is up, half is down. That's what it should be. This is actually like a growth industry. These are small companies. A lot is based on, spending on ads and growing that revenue base. And then, that revenue base comes back and buys more and more. And then you keep adding new customers, and that, sort of rolls on until it hopefully becomes, a big business. So 50-50 decline, or like what we're seeing, which is like double digit declines for smaller companies, is actually like a major point that cannot continue. It can't be that half are up or half are down, or, that there's a lot of brands coming down, because that's just like a sort of death spiral for this type of business. And yeah, I mean, we are also seeing it too. At least we're not seeing it on the big brands, right? And that's like a great signal. It's also worth saying, like, there's been a lot of talk about Meta and stuff. Like, we don't see any incredibly crazy things going on in Meta over this same time period. Yeah, some people are struggling, some people are doing really well, but like that always kind of happens with Meta, and CPMs are up, but click-through rates are also up. So like balances out a decent amount. But yeah.
So one of the things we talk a lot about is this bifurcation between when there is a period of struggle, big businesses have this existing customer base that they can depend on. Whereas these smaller businesses are really dependent on their capacity to drive net new customer acquisition. So Steve, we always sort of use AMER, the efficiency of new customer acquisition, as sort of the canary in the coal mine to the broader problem. Because in short periods of time, like we're discussing, big businesses can sort of squeeze value out of their existing base and offset some of these concerns a little bit. They can make the businesses look okay for periods of time. But what are we seeing as it relates to people's capacity to go out and drive net new customer acquisition efficiently over the last periods of time?
Yeah, we've certainly seen a decrease in AMER in the last year. And some of that is brands kind of pushing a little bit more spend into it. But as we were talking about, the spending power that brands have, the ability to spend and not degrade their efficiency as quickly, their AMERs quickly, has kind of gone down this year. We've seen that kind of tail off throughout the year. So it hasn't been that great.
So we always think about, people sort of generally acknowledge that there is a inverse relationship between spend and efficiency. But what people sort of underconsider is what you're describing, which is the slope of that line really matters. And when that slope gets steeper, that means things degrade quicker. That tends to represent a little bit of a softer environment from consumer spending, more competition. There's a lot of things that could contribute to it. But Jeremiah, you put together, I think, a really compelling visual that sort of allows us to look at over the last few years, some of this idea of consumer sentiment and how it might be contributing to some of these dynamics. So what did you share at that time?
Yeah, so the I feel like the question we usually focus on is around how do you feel about the economy, which is an important question as well. But this one was actually interesting because basically what we're looking at is asking people how has their spending shifted in the last 30 days, and then how do they expect it to shift in the next 90 days. And in both those cases, we're actually seeing the lowest, basically like present and future spending expectation that we've seen since we started collecting this data in March of 2023. And what's interesting is I just pulled up these numbers, looking at the University of Michigan Consumer Confidence Index, I just went back looking at 2022. So June of 2022 was an all-time low, 50. And June actually is like oftentimes generally a little bit lower time of year for all things kind of consumer oriented. But anyway, that was an all-time low. And then it was a 64 in 2023, 66 in 2024, and then it's down to 60, almost 61 in 2025. So we're actually seeing that the consumer confidence from other sources matches that as well. We're actually seeing lower numbers than we have the last couple of years. And actually, in our data, we're seeing a little bit of a bump up even in June. The spending expectations were lower for the first half of the year. So yeah, I think it's pretty interesting. And actually, one quick thing too, I wanted to call out the data that Yarden was talking about in terms of seeing this decline in new customers, and Steve as well. We actually flagged this a year ago in the D2C index as something to look out for. New customer revenue was down year over year, even though, or not fully down, but like the returning customer revenue was higher than new customer revenue year over year. And we flagged that as a possibility of this could be a bad signal for the future. And it's looking like that's actually the case.
You don't have to navigate sales tax alone. TaxCloud is the sales tax partner that does things differently. They give you real support from real people because you deserve peace of mind when it comes to your sales tax compliance, and it shouldn't have to eat at your margins. Businesses typically save an average of 30% when they make the switch to TaxCloud, and you can too. Sign up for a 30-day trial, and TaxCloud will give you free migration onboarding services when you decide to make the switch. Check it out at taxcloud.com/thread. That's taxcloud.com/thread.
So we have a culmination of revenue data from Yarden. We have the BuiltWith data and Shopify sites just existing in the as a percentage of the largest stores or sites on the internet. We have consumer sentiment concerns. And then Rishabh, you just sent over a CNBC article to me in the DMs. You want to talk a little bit about what that's sharing? Because I think, again, it's just another alternative signal to a similar point.
Think that, I generally, I'm like skeptical of like news. I don't want to make this political, but I'm like generally skeptical of like news media. And so especially when they like run surveys that say like, hey, e-commerce spending is like down in total. But like, yeah, I mean, coming into this conversation, like Taylor, I did like one last scroll just to make sure nothing else had blown up. And someone had quote tweeted my tweet saying, and by the way, and then had like linked to the CNBC article. And I was like, you gotta be kidding me. Right. And apparently they like ran a survey and found that like across multiple categories, e-commerce spending is down, which is not great, basically. So
yeah, and the headline. So I agree. We have to be careful with the sort of agenda of the article, but it says online shopping sees the biggest slowdown in over a decade as tariffs disrupt the e-commerce survey. And if you go down and look, what's really interesting to me, so they're referencing Alex Partners as a consulting firm that does what they call a home delivery consumer survey. So they're looking at consumers ordering things online for home delivery. So pretty relevant to us. And the categorical declines, like the three largest declines are in office supplies, sporting goods, cosmetics, furnitures, home furnishing, electronics and jewelry, and pet. Like that's like e-commerce. That is the absolute center of where we're going to sit. And these are 10 percentage point declines year over year. These are like big numbers they're showing a decrease in, which I think is like super interesting for that to sort of be tacked on to the end of this. So super. We'll link that as an additional reference in there. But what do you guys think? Let's talk causes, because tariffs as a consumer issue at this point in time feels a little odd. I don't yet have a great pulse for myself on what we think some cause factors are here. What are you guys feeling or thinking?
Earlier in the year, consumer sentiment and consumer spending was down. Like I don't know if you guys were I mean, I think you guys actually had shared some of this data back in like March. Like the consumer sentiment was down. I was tracking like travel data tends to be like a leading indicator for consumer spending, discretionary, and so you could see travel data was starting to go down. And so I worry that what happened was there was just general consumer sentiment reduction or consumer spending confidence reduction that got coupled with this blip on the tariff side that sent like what was already a declining thing into a little bit of a shock. But I agree with Jeremiah that it appears like we might be seeing early signals of rebound, but that's like my best guess is like we had two things get combined together that led that took what was already in decline and just give it like a jolt down, basically.
The other thing, one of the things that I think is interesting is the guys at Particle, they built this like inflation tracker that I think is pretty interesting. We'll link that here too. And if you look at some of the numbers on e-com products, especially like apparel and accessories is wild. Like the actual price inflation into some of these categories is like really insane. And so there is a little bit of wondering of like, man, did some of this stuff get a really strong presumptive, like people just going after price increase really quickly in a way that is more than we realized in some of these categories? That's another thing. I'm just trying to figure out, because we've got an all-time high stock market, we've got $110,000 Bitcoin. We've got a bunch of these other macro signals that are still pretty positive. So it's a little bit hard to figure out exactly where the lack of discretionary spending power is coming from.
I don't have firm data to support this, but on a personal note, the inflation of goods, like basic necessities over the last few years, I think I'm feeling like early this year, I felt the pressure of that more, where I'm like, how did my grocery bill turn into this? And it's just like that is, I think that's a piece of this, right? Where it's like it kind of takes a little bit of time for you to like catch up with the realization of like what the actual impact of these things are. And so the impact of that inflation was last year for most things. But yeah, for me, I'm like, I mean, we're like, okay, we actually are going to eat out less because it's just, everything's become so expensive. And every time I go to the grocery store, which is like 4 times a week, I've been spending between $100 and $200 on groceries. And it's like basic stuff. I'm not like buying crazy things, right? So I think there's just also like a piece of it that is inflation having an impact on things costing more. And I was trying to look this up right now. Actually, I don't think wage growth has kept up with that, right? So I think that's probably a factor here.
I was trying to think about this question before. I mean, Jeremiah brought up one point that I think is like the data backed point, which is, we've been seeing that repeat revenue, revenue from repeat customers is what has been carrying most of the growth. And new growth from new customers has been down or flat or like up a bit, but nothing impressive at all. And, we've been flagging that for a while, that if these people there's a certain amount that you can squeeze out of them, but you need new people in the funnel. And if, repeat is always growing more, then you're, in for a tough ending.
Yeah.
That's the data backside. I do have another theory I was thinking about that I don't know if it's true at all, but I wonder if like e-commerce has a maximum to it of like, there's a certain amount of people that will buy pots and pans online. And those people have now found the brand they've already bought. They find the brand that they like. They will keep buying those. And, maybe they could get caught to a new one, but it's kind of like this maximum that we may be hitting and, starting to decelerate a little bit because, the big brand's already there. The customers are already buying what the customers are. And it's harder to just get new people to buy online because the ones that are are already buying their certain products online. And, some people will buy home goods, but not clothes. And some people buy everything and some people buy nothing, right? But
So I think this is a huge factor. I think that COVID growth rates basically pulled forward like TAM capture to levels that now brands can't grow out of. Like we have seen this play out so many times that these e-commerce businesses that got really big during COVID are now trying to reset to figure out like what is the actual addressable market today for this product category? Because what COVID represented it to be is not what it actually is today. And you have this sort of combination of like now deflated demand matched with massive influx in competition. And then the expansion of e-commerce as a percentage of retail is like, when we say it's a growth sector, we're talking about like it's growing 15 to 20% as a percentage of total retail, but total retail is growing, whatever the GDP growth might be similar in there. So that TAM expansion for a lot of these things is not that large. And so you are running into real issues about the amount of men's underwear buyers. Like the supply side of competition is outpacing the growth of the category in ways that makes this like really hard for these brands to continually put up 50% growth every year. It's just not there. Like the market just isn't there for some of these brands at the size that they're at.
And if a brand is putting up 50% growth, that means competitors in their category are declining. That's the only way that can happen.
That's right. Because the category growth is just not large enough in some of these things. And so that like, there's a really interesting, like, what is the expectation of our industry that almost is like a reset that we're going through of like, what does it mean to be really successful? And how do we reorient ourselves coming out of a period of such like wild growth numbers? And this goes back to like that year over year growth I do in the GDC evolution, where it was like the average growth rate of the store set in 2020 was like 70%. In 2021, it was like 75%. And then it was 40, and then it was 30, and then it was 14. And that 14 feels really, really bad if the other numbers were 70, 60, 40, right? And so I think there's still this like realization out of it. I want to throw another set of data here that Leo, our friend from Vital Loop, who couldn't join us because his son is playing, I'm sure, some incredible piano concert here, and he's overachieving while my kid is just like still ramming his head into the wall. But he said, I think one of the scariest things for me, that when I think going back to this idea of the small businesses and tariffs, and we move out of the consumer side and we think about this from the brand perspective, he said that in the month of April, basically 1% of their customer base closed shop or asked for Chapter 11 financials for the month of April. And that's as many as the previous year in total. Like that's a year's worth of foreclosures in a month. Now, obviously that is really related to tariffs because a lot of these brands are just non-viable at a 50% increase in gross margin. There just isn't money for that. But that is a signal for me. We're now looking at Vietnam at 20%, China at 50%. I don't know how, if you have declining efficiency of acquisition combined with massive compression of gross margin in a business that's running at in a median EBITDA like 8%, like where do you go from there? Like where does a brand go on average if that's what the dynamics are like?
I don't want to overshare, but I think 1% is small for what it's worth. Like I think that is like there's like even within that there is selection bias because like without getting into the details, what we saw in April would suggest that is understated relative to like what was actually experienced by
right.
people.
If you think about the amount of brands that have the sophistication to reach out to and set up Final Loop, like you're already in a subset of financial sophistication for sure.
Yeah.
So we do the other thing though that was interesting that Leo shared, and I think this goes to the idea of Tale of Two Cities that you started with, Rishabh, is this idea that okay, for a lot of the brands though, the bottom line increased a lot in May and June in a dollar basis because a couple of things happened. One, we saw a substantial decline in OpEx. So what that practically means is I think a bunch of people got laid off. Like that people that organizations just got way leaner. They just didn't have a choice. And then two, they probably pulled forward a bunch of revenue to try and offset the tariff cash outlay that they were going to try and realize. And so you have these 2 months that look good on a P&L basis. But I think even for those brands, that is actually might be a counter signal. Like you shouldn't have
totally.
this, you don't want a sudden influx of profitability and ahead of the key growth months in the year.
I think this actually points to what Steve and Yarden were saying earlier, which is like when you do repeat customer pull forward. So like one of the biggest things that happened, and we saw this like very directly, and it sounds like you guys saw the same thing, which is that there was actually more happening on retention. So on cheaper dollars in for revenue out, but actually your AMR is becoming worse because your new customer acquisition is worse. So that it creates this yet other situation, which is where people were upset or saying that I was like, saying that I was publishing incorrect data. Like, yeah, if you're recharge, like, yeah, that's good, right? Like, it turns out that when you're trying to get your existing customers to buy more, like, you will see growth. Or if you are a retention marketing tool provider, you will see gross growth. But actually, it is not obvious that you are seeing net growth. So, like, what is underneath a lot of this that is like impossible to deconvolute and is like private data with all of these SaaS providers is like, how often is that person being asked to repurchase something or to purchase something else from that store? And so what you actually don't know is, Taylor, is exactly what you're saying. Like, are you actually pulling forward existing customer demand also right now? I don't know, right?
Exactly. And that's where
that's
like
like super scary. Yeah.
Right. And that's where like when Aaron Rubin, so Aaron, who's not here to defend himself, so I won't try and represent his position too much, but he jumped in as a counterpoint in this thread, which is everybody should go read the original thread here because it's a good set of conversations, saying like, look, because he's a 3PL, he fulfills orders, and he says, look, our order volume is up. Like, what are you guys talking about? But that to me is like a almost useless data point in the sense that like you have no sense of the net reality of those orders, and you don't know whether they are new or existing customers. That could be a tariff sale where they liquidate, like you just have no idea that order volume is producing anything positive to where we're at. And I think that sometimes everybody sees the world through the lens of their data, right? And I think it's hard to sort of tie it all together. But that's why I like that there were so many different angles to this. The one that I thought was weird, because I think they represent a pretty large sample set. Now, again, they shared anecdote, not evidence. So I do want to caveat that, was Max and the Triple Whale guys saying like, this is not what we're seeing in our data. And he kind of went directly at you. I don't know what you thought of that.
I tell Rava all the time, Max is my biggest Twitter fan. So yeah, I get a lot of engagement from him. I don't know what that means. And I think that, and this is the part that I wanted to say somewhere, and I should have just said it. It's like, you have to understand my incentives for my business are for this to not be true. Like, I like, I gain nothing, but in fact, I lose a lot if this happens to be correct, right? So I want it to be not true. I want it to be circumstantial to just me. I want the data to be like, I want all of this, right? And so the problem when someone like just says something without providing evidence is you have no idea, like how much of it is them trying to share whatever, like, is the last dashboard they saw internally in their company, or is there some incentive at play that is like saying like, hey guys, don't worry, like things are good, right? Like just like how, a politician will never say we're in a recession, right? Because it's just like, they're not going to get reelected. I don't know if some of that is.
Right. So Steve, where do you think we go from here? What are you seeing? I know one of the things that we track a lot too is discount rate, and just trying to see that as a signal for like, what is the capacity to drive demand absent having to offer discount and price. But what are you seeing on that front? And is there anything in the data in the nearer term, maybe in the last few weeks, even that signal some possibility or hope, or where do you believe we go from here?
So the consumer survey side of things looked weaker in Q1, and that like it bottomed out in
February. It was ugly.
Yeah. Yep. February. And even in first week of January, people were making their New Year's resolutions. I intend to spend less in the next 3 months. That was the lowest signal we ever got in that question. Everyone was intending to spend less as their New Year's resolution. Then they said they did spend less in February, and they identified and enjoyed saving more than spending in February at the record low. So that was, all those signals don't add up to a great outlook. And we kind of saw that kind of play out. The uncertainty of tariffs, of conflicts, even if they're abroad, money is being spent there and potentially resources are allocated there, and the US could get involved on some level or another. So all those factors of uncertainty don't lend to the consumers being confident. Consumers like being certain about things before they're going to go out and try new products. So I think that also lends itself to people repeating and having that tendency to use brands that they have. So what we've seen recently, though, is a nice uptick in all those, the future spending, present spending, and people enjoying the value of spending their money. We saw that kind of in the end of June, and it's a beautiful thing to finally see.
And that kind of resonates. Yarden, I want to come to you because one of the things that we've had a number of brands that were maybe importers from China that were suddenly looking at international markets as like a potential, maybe this represents growth sector for us. And Yarden, you got on this call. Now, whether this is marriage euphoria or something else, I don't know, but you felt like actually really optimistic about the future in Israel, the future of where things were at. It was like a really positive sentiment, it seemed like. So what do you think about sort of maybe you can pontificate briefly on the idea of other markets besides the US as opportunities for brands? And then what do you think about consumer sentiment and how does that show up at all, if at all, in Veros data in the more recent term too?
I don't think I have I don't have a formulated opinion on international markets to buy.
But maybe share your anecdote, because I think just it was an interesting perspective for me to feel like, oh man, like the actual ceasefire to some of these conflicts brought a sense of possibility, maybe.
Yeah. Okay. So yeah, I mean, I was saying like, I think now is about to be like a golden period in Israel and in the Middle East in general. I think Israel now with, the US's backing, that now there's a ceasefire in Iran, that became less of a threat. A lot of the other enemies became less of a threat and more hostile countries. And there's hopefully going to be, the extension of the Abraham Accords, which is a peace and economic deal with Saudi Arabia and with Syria. And that basically puts together, lots of different economic opportunities and oil pipelines and so forth that will, bring wealth to the US, to Israel, of course, to, the Arab countries in the region. And it also calm tensions a lot down and bring more, of course, tourism here, but straight up business and, Saudis opening up venture funds in Israel and things like that. So people are, very, very excited. They're still, worried and things like that. But I think Bill Ackman had like a really good tweet of like this and this and this and this and this, like can now cascade. And so, yeah, I mean, there's definitely a lot of optimism here from that end.
Yeah. So the other thing I think that we have to consider is that one of my biggest concerns all the time is the lack of the availability of capital is just such a death knell for e-commerce brands. It's just such a capital intensive business. And so there is a lot of pressure, I would say, from the US government to try and get the Fed to lower rates. Rishabh, do you expect lower rates? Do you think that can be another way that this becomes a little bit of I feel like there's a foot on the throat of all these brands because they have to self-fund growth because the debt is just so expensive and hard to access right now. Could that be a thing that creates some positive relief going forward?
I think there's a few things that make me extremely optimistic in the 18-month time horizon, just to yes and what Yarden was saying. So the first is that the total number of IPOs has like gone up very quickly, which means that LPs are going to have more money, which means it has to get reinvested somewhere. A lot of it is going to be reinvested private. And in the private market, it's like you can invest in consumer, you can invest in software, but I think that we are just going to see overall more investment, which I think will lead to consumer investment again. I think the other thing is that like 3 years ago, there was a bunch of VCs who said like consumer is dead. Okay, whether or not they said it out loud is a different issue because like nobody wants to cut off deal flow, but that's what they were saying. And then it turns out the biggest hit was ChatGPT, which is a consumer company, right? At the end of the day, like, yes, they're adding on B2B use cases, but it is a consumer company. And when you think about consumer spending in general, like, yes, that is a format of consumer spending. And so I think that it will reopen people's minds to consumer investing, again, software or goods. Just generally the fact that people want to spend or invest in consumers is good. And then I think the final thing, which is totally underappreciated, which Eric Seifert, have you had Eric Seifert on one of your pods?
Yeah. I've been on his. He's awesome. I love it.
Okay. Yeah, he's the best. I think this is like one of his biggest points is like the models have not yet built an ad product. And I think that when they do, which they will, right? Like Fujisimo did not get hired to not build an ad product by OpenAI. Okay, like that is like what she is going to do. And when that happens, the total amount of consumer surplus that will be created is going to be ridiculous. And it is going to inject a massive amount of fuel into the consumer goods businesses. And I am like, I mean, I love ads, but like this is going to create so much good for us when that happens. Yeah.
Yeah.
So those are like the three things that make me extremely optimistic that there will be more investment and that there will be more surplus put back into the system over the next 18 months.
And not even just IPO. There's been a number of really solid mid-market, you could call them mid-market acquisitions from Dr. Squatch, Touchland, Haya, Wow. Like there's been a lot of solid exits in the consumer space that I think do sort of refuel interest. So if you could get that combination of like equity dollar interest as well as debt equity value or debt value, like that is what fuels growth in this industry. The availability of capital is what fuels growth because it just gets people to be more aggressive on their willingness to push out the latency of value capture in reality. Like it's so I think there is opportunity for that. What would be really discouraging, I think, though, is that if there was in the short term this real continued decline in consumer sentiment such that they felt that sort of really made things soft for a while in this next period, because I think this tariff thing to absorb it, brands are going to have to work through a combination of cost-cutting measures as well as like some changes to supply chain that are going to be expensive and other things that like if a period of declined efficiency would really be a difficult thing for a lot of brands to overcome. And I think we'd see that bankruptcy element rise for sure.
I also, one thing to add is I think that e-com is an industry that is very reliant on SaaS. And I actually think that may work very much in its favor in the next 18 months with the rise of AI. Because if AI talent now builds towards e-com, like AI is going to and is currently changing the world. And if the smart minds, for some reason, the person that starts a company, they're like, I'm just going to sell to e-com companies, right? For whatever reason, right? There's a lot of them. But if that happens and their focus and energy goes towards e-com, that is going to be an amazing, amazing outcome for it. And, you could think of the course ads, but also, hey, you don't need to go into the store, use my AI to try on these clothes. And for the first time, that can actually work. And a million other endless use cases for efficiency and for growth. And if that happens, that also, aside from just ChatGPT being able to run ads on ChatGPT, like to be able to actually use this stuff for the business to even grow that TAM for e-com in general is really exciting.
I mean, not to like shill CTC on Taylor's behalf, but that's like what Taylor is like. You would not be able to hire CTC if you were a small brand prior to a lot of this technology becoming possible. Like you just wouldn't. And so I think like I couldn't agree more. Yarden is like the fact that you can create, and by the way, this goes to the layoff point that someone was making earlier, which I think is like very true, unfortunately, but I think you can just build much leaner businesses. Yeah.
And you're describing our thesis exactly, which is like, I just think that the fundamental cost to deliver the service at the level that we can deliver it is just on an absolute downward trajectory. In a good way, right? That we can use tech enablement to deliver enterprise level service quality to 7-figure brand. And I think you guys are all doing that too. Like Yarden's product's free. Jeremiah is like committed to those not overcharging and following this sort of generalized SaaS playbook. Like Rishabh, you guys do the same thing. You guys are all about creating enablement for this market. And so when I think about like the icon.me's of the world or these other products where there has been a lot of venture dollars flown in to build products to serve our industry, like we should hope they succeed. We should hope that they win because they do. They come in and create value that allow us as business providers. Now, the question of whether the proliferation or the commoditization of these functions, like across too many people, actually like just tears down the walls to the barriers to entry too far is like probably a separate topic for a separate podcast. But I think that there is certainly opportunities to leverage AI for the benefit of our industry for sure.
I mean, without getting too deep into it, I think it's just so unlikely. Yeah. I mean, this whole like everybody's going to build their own software like that. Anyway, yeah.
I think about it more on the brands.
I think
like
it's
that. Yeah.
super unlikely.
I think that it's more to me that what I've seen is that every category in e-commerce basically gets competed down to nothing because the barriers to creating a business are so low that when you think about a category like women's leggings, or you think about a category like masks, like we're dealing with very finite digital real estate on SERPs and Amazon listing pages and ultimately Instagram feeds for the top 2% of consumers on the world. Like these things just get competed down to zero, and the middlemen sort of take the rake on as it grows is more my concern when these barriers get so low for the brands to be creative. That's like, it's the same thing, no different as agencies or anything else. The capacity to compete is pretty low right now.
I do think though I think a little bit of what we see in the space though, in terms of bigger brands at least doing well and smaller brands not doing as well is exactly that, Taylor. Like I think if I look at like a true classic, could somebody else go out and sell basic t-shirts? Yeah, there's thousands of brands that do, but you get to a large enough size and you have a big enough brand recognition and you will be fine in that context.
And you can't profitably acquire a new customer anymore. Because like what the reason True Classic will defend the territory is because they can afford to lose money on acquisition because they have so many existing customers driving way up that base. So what happens is the price to acquire a new t-shirt customer is now no longer profitable for an upstart. And so you just can't wade into those waters and compete in a way that you could at the beginning of this journey. But that's why you're seeing this. The other thing that's like a trend in our industry is like this renewed emphasis on IP is like, you just need some defensibility to protect that spending power slope not looking like this. Like, how can you continue to be able to invest without the massive decline in CAC from an influx of competition? Like that's a huge piece of why Ridge has been able to sustain their growth for as long as they have, is like just the ability to not have 7,000 counterfeit versions of your product is like a hugely important part of this journey. But all right, guys, this is great. What else? Anybody got any finishing lines that you want to end with? That maybe let's do this as a bet. You can give me a finishing line and a bet. Q3 consumer sentiment is up or down versus Q2. Jeremiah, what do you think? You're the survey guy.
I'm going to say it's up. Q3 up from Q2.
Steve?
Yeah, I'm going up. Looking at the numbers now, Q2 was a little rough, so I'm thinking up.
Okay. And Yarden, what do you think?
I'll just be contrarian here and say down.
Come on, you were all the golden era. What happened to the golden age that you were espousing?
No, look, I mean, I can take either one and make the argument for either one. My issue is a broader, like, the market is up, but like debt is up and interest rates are so high, and like the vibe is not good. Like in general, you talk to people and you don't, like, I don't know, things are not the vibe of S&P peaks, even though there's this disconnect that, like, I think, I and many people have been waiting for the other shoe to drop and they don't know when, and then it bounces back up. And so, I have those hesitations, but obviously a good bet is also, Q2 was down, so it's probably going to be better than that.
All right, Risha, bring us home. What do you think? Q3 up or down?
Yeah, I think it's up for sure. Yeah. What do you think, Taylor?
Yeah, it's funny. I share Yarden's sentiment. I can't really make out an understanding of the macro market right now. It is very confusing. Like the asset price inflation versus the underlying tariff problem versus the layoff. I think the one thing that's really hard for me to sort out is like, what is the net benefit from what's happening with AI that seems to be happening so fast? Like, there's people that I listen to that are this is going to massively transform GDP. This is going to change the world for all these positive ways. And then there's like, of course, the doomsdayers related to what it's going to do to the labor market in the short term. I don't feel clear on that yet. And so I think it's hard for me to say. In the nearest term, I'll say flat to down. I think I just don't see any immediate trigger for positivity unless you get a crazy rate cut, which I just think Mr. Powell is just going to hang on for dear life and refuse to give that to Mr. Trump until he's booted out. So I think we're going to have to wait a little bit till Q4 for that. All right, guys, I appreciate you all stopping by. Follow each of these gentlemen on Twitter. They're there to spark the controversy and give you something good and exciting to engage with. But we appreciate all of you stopping by, and go to d2cindex.com and sign up for the newsletter. We'll be publishing a lot of this data and charts and information as we go. And we're going to continue to try and find guests to add to that set of information to keep you guys informed as best we can about what we believe is happening in our industry. Gentlemen, appreciate you all stopping by.